It's a short holiday break for Congress as lawmakers return to the table this week to hammer out a debt deal before that August 2nd deadline. Democrats want to eliminate tax breaks for the wealthiest Americans, including those for hedge funds. Is this the right move? Opposing views from Chicago securities attorney Andrew Stoltmann and Tom Curran, his partner at Pekar and Abramson. Guys, good to see you. Andrew, I'm going to start with you. Carl Levin has been very vocal about this on the floor of Congress. He thinks absolutely that hedge funds should be paying more, especially when it comes to the service fees, as he calls them, the way they should be taxed. What do you think? Is that a good idea?
Yeah, I think it's a no-brainer. I mean, it's outrageous to argue that hedge fund managers who have made billions of dollars in the last couple of years should be paying a tax rate lower than people who make $25,000 a year. It's hard to believe we're even having this debate. It's a no-brainer.
Is it a no-brainer, Tom Curran?
Yeah, it is a no-brainer, as in you'd have no brain to do this. It's real demagoguery. It's going to generate, if you do it, it's not going to generate much by way of revenue. It's not a serious solution to the serious problems that we have. More importantly, it would have a devastating effect on long-term capital gains in sectors like real estate and real job creation sectors.
But speak to the spirit. I mean, Andrew didn't really lay it out, but speak to the spirit of the criticism of the other side, which is, this is income. It's ordinary income, or it should be treated like ordinary income as opposed to capital gains.
But it's not. It's the distribution of capital gains that is in favor of economic activity. I mean, that's proven. If you want to call it something else, you're going to be really targeting the specific hedge fund industry in a way that is using the tax code, I think, in a dangerous way. I think
Why is it dangerous?
Well, because you're going to be targeting very specific sectors within industries themselves. It's going to set a precedent for the further politicization of the tax code that I think is not something that we really ought to be doing right now.
But the problem is that these are not capital gains. It's basically ordinary income, and you can make the same argument.
But it's not basically. It's
sure it is. Of course it is.
It's a share. It's the manner by which capital gains are distributed in an investment partnership. That's what it is.
You can say the same thing that a pension fund manager who might get an actual income, a salary, and also a bonus. He should have his entire compensation taxed at 15%. It doesn't make sense. And the argument that, gee, it's going to destroy jobs and we're not going to have economic growth with respect to those industries is pure fallacy.
Well, it's not pure fallacy, and I'm not expecting Mr. Levin to particularly care about that anyway. But these are strictly capital gains, and if you do it, they'll simply revamp the structure of the hedge fund in order to reflect it anyway. And at the end of the day, we're going to talk about raising very little money when we're facing $4 trillion now, and it's that the administration and Congress is trying to cut.
The White House
is just
disagrees.
not going to do it.
The White House disagrees. The White House says $25 billion will be raised over the course of the next decade because of this tax hike.
Okay, and we still have more than 9% unemployment after $800 billion. So I'm not sure I rely upon the White House's numbers.
Mr. Stoltmann, address Tom's point about the use of the tax code to target individual industries, and it seems hard to argue the fact that this would do that. Don't we have enough of that already in the tax code?
But the thing is, we're not saying hedge fund managers should pay more than anybody else earning over $250,000 a year. All we're saying is that they need to pay the same amount. And, when we have a $14 trillion deficit, I don't think that's too much of a request to make of these people.
But are we changing the definition here, Mr. Curran, to suit the circumstances? In other words, what I'm saying here is that when we need revenue, we decide that this income ought to be regarded as regular income. When we didn't need, I assume there was some reason way back when that this income was regarded as a capital gain income.
Because that's what it is. They tried this before. They tried it when things were before the economic crisis, and it was beaten back then because if you're going to change this long-term capital gains on partnerships generally, you're going to devastate the real estate market, and that's not exactly what you want to be doing in today's housing market.
Explain how that would work, Tom. How would it devastate it, and what other industries or sectors of the economy do you think would be vulnerable specifically?
Well, specifically, new construction based upon real estate developers coming together together and incentivizing the development of building. The American construction trades were against these proposals, pre-2008 when they were raised. These are capital gains, and if you disincentivize this economic activity in a fragile economic recovery at best, you're really doing a disservice, and particularly so when you consider the amount to be gained in terms of the overall debt.
Andrew, last word.
Yeah, I just think the reason why we have this discrepancy in how hedge fund managers get compensated is really because of the lobbying group of the hedge fund industry. Very strong, very powerful. They have done a fantastic job.
Well, they're important here in New York, I can tell you that.
All righty. Andrew, Tom, thank you so much.